On March 1, 2026, the Social Security Administration implemented changes that directly affect retirement income across the United States. For millions of Americans who depend on Social Security benefits as a primary source of financial support, these updates are not minor administrative revisions. They influence how much money is deposited each month, how much is withheld before payments arrive, and how much retirees ultimately retain after premiums and taxes are deducted. The agency confirmed a 2.5% cost of living adjustment for the 2025 benefit year. For the average retired worker, that adjustment equals roughly $50 more per month, or approximately $600 over a full year. For married couples in which both spouses collect benefits, the combined increase may approach $1,200 annually. Those revised amounts are now reflected in current monthly deposits. Yet the headline number does not tell the entire story. The cost of living adjustment is calculated using the Consumer Price Index for urban wage earners and clerical workers, a broad measure intended to track inflation across the general workforce. Retirees, however, spend differently than the working population. A larger share of retirement income is allocated to health care, prescription medications, housing, utilities, and insurance coverage. Over the past several years, these categories have experienced sustained and, in many regions, pronounced price increases. While official data may show moderate inflation, many retirees report that grocery bills, electricity costs, homeowners' insurance premiums, and out-of-pocket medical expenses have risen at rates exceeding the published adjustment. The result is a gap between the official inflation figure and the lived financial experience of older Americans. Recognizing that gap is essential for realistic budgeting and long-term planning. Beyond the cost of living adjustment, a more consequential structural reform has taken effect. For decades, two federal provisions reduced Social Security benefits for certain public sector employees. These provisions were known as the Windfall Elimination Provision and the Government Pension Offset. The Windfall Elimination Provision modified the benefit calculation formula for individuals who received a pension from employment not covered by Social Security taxes. Many teachers, firefighters, police officers, and state or municipal employees participated in pension systems that did not withhold Social Security payroll taxes. At the same time, a significant number of these workers held other positions during their careers in which they did pay Social Security taxes and earned qualifying credits. Under the Windfall Elimination Provision, the formula used to calculate their Social Security benefit was adjusted, often resulting in a reduced monthly payment. The stated policy objective was to prevent what lawmakers described as unintended advantages. Critics contended that the rule unfairly penalized individuals who had paid into the system through other employment. The government pension offset affected spousal and survivor benefits. If a retiree received a government pension from employment not covered by Social Security, any Social Security spousal or survivor benefit could be reduced by as much as 2/3 of the government pension amount. In some cases, the offset eliminated the spousal benefit entirely. Surviving spouses who anticipated support based on a deceased partner's work record were sometimes informed that they would receive little or no benefit because of their own public pension. These provisions affected approximately 3.2 million Americans. After years of legislative debate, federal lawmakers enacted the Social Security Fairness Act, which permanently eliminated both the Windfall Elimination Provision and the government pension offset. The repeal represents a substantial shift in benefit policy. Individuals whose payments were previously reduced under these provisions are now entitled to recalculations using the standard Social Security formula. For many retirees, this means higher monthly benefits. In addition, because reduced payments may have been issued for years, the Social Security Administration has begun processing retroactive lump sum payments to compensate for prior underpayments. The financial impact varies based on individual work history. Some retirees may see increases of approximately $200 per month. Others may experience increases exceeding $400. Retroactive payments in certain cases amount to several $1,000s, with some beneficiaries receiving $5,000 or more, depending on the duration and scale of previous reductions. Eligible retirees should review their updated benefit statements through their secure online Social Security accounts or contact the agency directly to confirm recalculations. Given the volume of cases nationwide, processing times may differ, and accurate employment documentation can assist in resolving outstanding questions. While some beneficiaries will see higher gross payments, it is equally important to consider deductions that occur before funds reach a bank account. Medicare. Part B premiums are typically withheld directly from Social Security benefits. For the 2025 coverage year, the standard Part B premium increased to $185 per month, up from $174.70 in the prior year. This represents an additional annual cost of $123.60. For retirees receiving an average $50 monthly cost of living increase, the higher Part B premium reduces the net gain. Instead of retaining the full increase, many will effectively see closer to $40 per month after the premium adjustment. Higher income beneficiaries may face an even greater reduction due to the income-related monthly adjustment amount, commonly referred to as IRMAA. This surcharge applies when modified adjusted gross income exceeds specified thresholds. Crucially, Medicare determines IRMAA liability using tax data from 2 years prior. Premiums assessed in 2025 are based on income reported for the 2023 tax year. Under current thresholds, individuals with income above $106,000 and married couples filing jointly with income above $212,000 are subject to higher premiums. At the top income brackets, monthly Part B premiums can exceed $600. When combined with prescription drug plan surcharges, the annual cost may surpass $7,000. Not all retirees subject to IRMAA are consistently high earners. A single year of elevated income due to the sale of property, a large retirement account distribution, or realized capital gains can trigger higher premiums for up to 2 subsequent years. Because the surcharge is applied automatically based on tax records, many beneficiaries do not anticipate the increase until they see it deducted. If your Medicare premium has increased because of IRMAA, write in the comments how much more you are paying each month. I want to see how many retirees are being affected by these higher income-based adjustments. Federal regulations allow beneficiaries to request a reassessment when income has declined due to certain qualifying life-changing events, including retirement, divorce, or the death of a spouse. Form SSA 44 may be submitted to request a new determination based on updated income information. Successful appeals can reduce premiums back to the standard rate, potentially saving thousands of dollars per year. Another important area involves the earnings test for individuals who claim benefits before reaching full retirement age but continue to work. For the 2025 calendar year, beneficiaries who remain below full retirement age for the entire year may earn up to $22,320 without benefit reduction. Earnings above that threshold result in the withholding of $1 in benefits for every $2 earned over the limit. For individuals who will reach full retirement age during 2025, a higher limit of $59,520 applies to income earned before the month of attainment. In this category, $1 in benefits is withheld for every $3 earned above the limit. Once full retirement age is reached, the earnings limit no longer applies. It is important to understand that benefits withheld under the earnings test are not permanently forfeited. Upon reaching full retirement age, the Social Security Administration recalculates the monthly benefit to credit months during which payments were withheld. Nonetheless, temporary reductions can create cash flow challenges for working retirees. Taxation of Social Security benefits presents another layer of complexity. Although payroll taxes were paid during working years, federal law permits a portion of Social Security benefits to be subject to income tax, depending on total income. The calculation relies on combined income, defined as adjusted gross income plus non-taxable interest plus 1/2 of Social Security benefits. If combined income exceeds $25,000 for single filers or $32,000 for married couples filing jointly, up to 50% of benefits may be taxable. If combined income exceeds $34,000 for individuals or $44,000 for married couples, up to 85% of benefits may be subject to taxation. These thresholds were established decades ago and have not been indexed for inflation. As benefit levels and retirement account distributions increase over time, more beneficiaries cross into taxable ranges, even if their purchasing power has not significantly improved. proactive tax planning may help mitigate unexpected liabilities. In light of these developments, retirees should review their Social Security records carefully. Establishing or accessing a secure online account allows beneficiaries to verify earnings history, confirm payment amounts, and monitor any recalculations associated with recent legislative changes. Because benefits are calculated based on the highest 35 years of indexed earnings, inaccuracies in wage records can materially reduce lifetime payments. Errors should be documented and corrected promptly. Individuals previously affected by the windfall elimination provision or government pension offset should confirm that their records reflect the repeal of those provisions and that any retroactive payments have been properly issued. Maintaining detailed documentation of employment history, pension participation, and agency correspondence can facilitate resolution of discrepancies. Social Security remains the financial foundation for millions of retired Americans. Each adjustment in benefit formulas, premium schedules, earnings limits, and tax thresholds has direct consequences for household stability. The changes implemented as of March 1, 2026, create new opportunities for some retirees through higher recalculated benefits and retroactive payments, while also underscoring the importance of monitoring deductions and tax exposure. Remaining informed, verifying personal records, and seeking qualified professional advice when necessary are essential steps in navigating an evolving retirement system. For those who spent decades contributing payroll taxes, understanding these rules is not optional. It is a critical component of protecting income in retirement.